In a previous episode, I discussed how certain gifts, if made within 3 years of death, can be disregarded by the IRS under Code Section 2035. There's a lot of nuance to these rules. However, where gifts are made to a spouse, there can be planning opportunities that are unforeseen, especially within the letter of this actual code section. I'm Griffin Bridgers, and this is 10 Minutes with Griffin. Today's episode, episode 236, is all about spousal gifts under Code Section 2035. As always, this presentation is not intended to substitute for legal or tax advice and is provided for educational purposes only. A little bit about me. I do what I do because I enjoy speaking and teaching. So, this is my passion, and if you like what you hear here, or if you'd like to use me as a speaker for your upcoming event, whether it's in person or virtual, or for an in-house program for your organization or firm, please email me at griffin.bridgers@gmail.com. And if you'd like to subscribe to my newsletter, you can visit griffinbridgers.substack.com. Now on to the presentation. As a quick refresher, Code Section 2035 in general really just acts to ignore certain types of gifts or transfers if made within 3 years of death. One is a gift of a life insurance policy. Another is a payment of gift tax made out of pocket within 3 years of death. And finally, releases of certain retained interests or incidents of ownership in a life insurance policy that are released within 3 years of death other than through a bona fide sale are disregarded by the IRS as well. Now, all of these kind of shoehorn into some of the general discussions we've had about the purpose of making gifts in the past, typically reducing estate tax by either freezing the value of assets in the gross estate or the estate tax calculation, and also maybe using the lifetime gift tax exclusion in case it goes away so that you get a higher applicable credit against your estate tax at death. However, in the context of Code Section 2035, we must look beyond those basic purposes to examine the fact that there are certain special tax benefits that can be gained by making lifetime gifts, other than those basic objectives which seem to sweepingly apply to most types of gifts and lifetime transfers you might make. In particular, there are certain benefits you can obtain that are subject to 2035 as well. And the reason these come up is because they rely on comparing the value of certain business or farm assets or interests to the value of the adjusted gross estate, or the gross estate is adjusted. A better way to put this is that this can be considered the equity value of the gross estate after subtracting maybe secured debts, and also in some cases unsecured debts and claims and administrative expenses. Now, today's discussion isn't about the specific requirements and nuances of these, but just to name a few, you have the redemption of stock under Code Section 2033, which grants capital gain treatment to stepped-up basis corporate stock if redeemed by an estate to pay estate taxes and administrative expenses. But to qualify for that treatment, then more than 35% of the adjusted gross estate must be comprised of the corporate stock. Similarly, there's another 35% threshold that can be exceeded, and if you do that, you get a special benefit for a business interest, where you can choose to pay the estate taxes that are attributable to that business interest in installments, which kick in 5 years after death and continue over a period of 10 years. So, in order to qualify, like I mentioned, the business interest has to make up more than 35% of the adjusted gross estate. Then finally, the Code Section 2032A special use valuation allows you to take farm real estate or real estate that's used in a closely held business and get an appraised value that's reduced up to a certain amount down to the approximate current use value instead of the highest and best appraised value. In order to qualify for that, you have a 25% and 50% threshold of the equity value of the gross estate that have to be comprised of, in the 25% test, the equity value of the farm real estate, and, in the case of the 50% test, the equity value of farm real estate and personal property equity. Now that I've given you that background, I'd encourage you to look at each of these code sections in greater detail. If you don't have the one for the installment payment of estate taxes, that's code section 6166. But the common thread here is that you have a certain asset composition when you compare the value of the adjusted gross estate to a business interest or business asset. So because of that, in order to meet that 35% threshold, it can seem tempting and practical to gift non-business assets during life in order to skew the proportion of the business or farm property to the adjusted gross estate or to the equity value of the gross estate. Now, Code Section 2035 also ignores these types of gifts if made within 3 years of death for those specific purposes. So in other words, if you want to meet that 35% threshold or that 25% or that 50% threshold, these typically have to be met both with and without gifts of interest that are made within 3 years of death. So it seems like that takes away an angle of planning that would be intentional. But there's another catch to the catch here, and that lies in spousal gifts, because when we're looking at these 3-year gifts, spousal gifts are generally going to be disregarded, either directly or indirectly. Now, the indirect type of analysis is for general 3-year gifts, like with life insurance or with any sort of transfer of a retained interest, because the effect of the 3-year rule here is that it would pull that gifted property back into the gross estate. But if that transfer qualifies for the marital deduction, you can offset those issues. And another benefit is that Code Section 2035 expressly and directly exempts gifts to a spouse that are made to qualify for those various value thresholds for the adjusted gross estate. So what that means is that if you wanted to intentionally plan for those other tax benefits we talked about, like special use valuation or stock redemption, spousal gifts of non-business assets could be an option to try to qualify for those planning and tax benefits. But there's a catch. The letter of the law says that only gifts made to a spouse that don't require gift tax reporting will qualify. So if you were to make an outright transfer, you typically wouldn't have to report that on a gift tax return if the outright transfer is to a citizen's spouse. So that's a benefit. But what this means is that you cannot transfer a life estate or marital trust interest that would require a Q-tip election, because making that election would require a gift tax return. So a better way to put this is that you can make gifts within 3 years of death to a spouse to plan for the AGE threshold planning, but in order to do so, it has to be a gift that's of the type that it's not reported on a gift tax return. So really what that means is that outright gifts to a spouse will be the best option here if you want to take advantage of this planning technique and this exception to the general rule regarding 3-year gifts. As always, if you have questions or topic suggestions, you can email those to me at griffin.bridgers@gmail.com. As a reminder, I cannot give tax or legal advice in response to your questions. But thank you again for listening to this episode of 10 Minutes with Griffin, and I look forward to seeing you in the next one.